Greetings. Welcome back to Happy Half Hour October version. We've got government shutdown, AI, gold, Bitcoin, things that we talk about a lot, but I feel like AI, gold, and Bitcoin are in vogue. They're doing well. They're top of mind for institutional and retail investors. So that's why we talk about it. The AI thing, that can go a multitude of ways. I've heard smart people that are fully on board with AI. I've heard really smart people that think it's a bubble, it's a fad, and it's not that groundbreaking.
Where do you come in?
I've been thinking about it a lot, actually. It has nothing to do with, it kind of has something to do with it, the stock price and the investment and all that. But I just can't get over the notion how 40% of the population losing their job is good for humans. That's a breach of the social contract. Look at all the unrest right now in France, in the US, around the world. And I can't wrap my head around how inequality is bad today. If AI takes off, wealth is going to concentrate among a handful of the same companies. The rich are going to get richer. Humans are going to be losing their job. I just can't envision a world where we stand by and let that happen. I eventually think that investors and society is going to boycott companies that fire their workers in place of AI agents and AI. Like, I can see that happening. And I can see the government having to step in and either putting some guardrails around AI, limits on how much companies can reduce their headcount. I just can't get on board with the extreme outcomes of AI displacing human beings.
You're coming in hot today.
Well, you asked me what I think, and
Yeah.
that's what's been going on in my head for the last couple months.
So that's a plausible scenario, or that's the most likely scenario, or that's a scenario?
That's a scenario, and that's the closest thing that I'll make to a prediction. Much like how ESG investors don't want to own companies that make guns or promote gambling, promote drinking, I feel like there's going to be a similar backlash against companies that displace their workforce in favor of AI. Investors are not going to want to buy their stock. Consumers are not going to want to buy their products.
Are there any investment implications of that, or too early days to really know how that plays out and who the winners or losers, assuming that your scenario comes to pass?
Any disruptive technology, I go back to the internet because folks that follow our content have seen the chart that I share that shows Netscape, when Netscape launched in the mid to late 90s, versus the AI theme. And those two technologies, as measured by the NASDAQ, are tracking pretty darn closely. Any disruptive technology, there is a disruptive period where there's essentially a washout. Text was 1999 to 2000, where all of the companies that slapped .com at the end of their company name didn't have any revenue, didn't have a viable business model, really struggled, and their stock prices went down by 90, 100%. A lot of them went bankrupt. I'm not saying that's going to happen this time, but there is going to be winners and losers. Right now, anyone that mentions AI on an earnings call is a winner. That's not how it's going to end up. There's going to be a subset of companies, and no one knows who those companies are going to be. Of course, investors are voting with their wallets, and there's some early leaders, but there's going to be winners and losers. And it's to be determined. Anyone that pretends to know how this all plays out is full of it. The government is probably a little bit nervous. Investors are probably a little bit nervous. A lot of these themes, some say, are starting to get ahead of their skis. A lot of smart investors that I follow are starting to pump the brakes on this whole AI narrative just because the payoff versus what's being invested just doesn't compute right now.
Yep, I think that's most of the stuff I've been reading is all of this investment, but where's the revenue growth? Where's the profit growth that's going to result from that? And it would have to be significant to pay back the hundreds of billions of dollars in investment that's currently underway.
Yeah, and I think folks can get distracted. People are talking about the shutdown. Yeah, I talked a bit about the shutdown in our market commentary. There's been 20 shutdowns since 1976. The market basically doesn't react to those. And to me, it's just another example of how most savvy investors don't take our government serious. There's very low expectations as far as policymaking and rhetoric and getting things done, and investors don't really pay attention to that. And if you are, it's a distraction from the question, in my opinion, is does the movement of the AI stocks, the upward movement, the promise of all this working out, does that pay off? That is the question, because 40% of the S&P 500 is predicated, or 40% of the S&P 500 is tied to this AI bet paying off. And if that doesn't happen, it's not going to be a subtle unwind. It's not going to be a gradual unwind. It's going to be very violent. And the last thing I'll say is we look at a lot of prospective client portfolios, and overwhelmingly they own S&P 500, QQQ, which is the NASDAQ. And then a lot of these companies, NVIDIA, Google, Meta, they own them outright. So you're triple exposed. You think you're diversified, but what you're basically doing is chasing a momentum technology index. And I'm actually writing about that this week. I've never seen anything like it. And it's hard to convince someone to change something that's worked. Investors don't think about the next year or the next cycle. They think about what's worked, and they look at performance of the best performing funds and they pile in. It's a sequence as old as time. And what we're trying to do is just educate people to get ahead of it. It's fine to take known risks. It's perilous to take unknown risk. And a lot of folks don't even know how much risk they're taking.
Yeah. And as you said, that taking that risk has paid off the last 3, 5, you could argue 15 years. U.S. stocks, large cap stocks, technology stocks, the Apples, the Googles, the Facebooks, etc., have been the top performers. That's been the place to be. And at some point, that will no longer be the case. And I think what you're saying is you just want to make sure you're not overexposed to those areas when that turns out to be the case.
Yeah, we certainly own a lot of these themes and AI names that we're talking about, but we're mindful of our exposure. What I'm talking about is not being mindful of your exposure, thinking the good times are going to continue. That's how you end up with egg on your face. A lot of these things that I'm talking about go unheeded during good times. Folks don't care. They like to see their portfolio growing. Or when the cycle turns and these stocks are down 40 or 50%, that's when you see people start to panic and unwind and sell. And it's a recipe as old as time. And I've seen it before. I started my career in 2007, 2008. That's when I really started to get into the investment side. And I always say you can't predict the next crisis, but you can predict how humans react to those crises. And I think the study of behavioral finance and human psychology is an underrated skill in investing. And that's something that AI can't take away. And with all these quantitative traders and hedge funds and black boxes, I think sometimes we forget that markets are humans trading with other humans.
So we're sitting here about 80, 85 days left in 2025. Hard to believe that we're now in October and holidays are fast approaching. What jumps out at you in the investment landscape? I mean, obviously you mentioned the shutdown and the relatively muted impact that tends to have on the market. We've got gold at an all-time high, almost $4,000 an ounce. We've got Bitcoin back in the mid-120s. What jumps out at you from an investment standpoint as we sit here today and look forward to the remainder of the year?
I think many investors are wising up to what's actually happening to the US dollar and debt. And look, I say US, but it's really every developed country out there has a similar backdrop where their currencies are losing value, the deficits are accumulating, and the debt is just stockpiling up. And that background is probably not going to change. If you sit left, center, or right, we can probably all agree that most governments are not going to get their fiscal act together. And you can say whatever you want about gold and Bitcoin. I know smart people that like both of those. I know smart people that don't like both of those asset classes. But the price is always right. And what you're seeing now is in my opinion, a secular tailwind to those two asset classes. And again, the price the last couple of years have validated a lot of the themes that we've talked about. And it's really amazing to see. It's happening quicker than I thought, where you're seeing a bet against the US dollar, a systemic bet against fiat paper currencies, and billions and even trillions flowing into gold and Bitcoin. During this government shutdown, digital assets saw 6 billion in weekly inflows. So all of these things are basically a bet. Bitcoin and gold, in my opinion, are a bet against the legacy systems, the legacy political systems, the legacy banking systems, the legacy ideas around debt. All of this is slowly and then rapidly going to change. And I hear a lot of investors talk like, oh, gold's at all-time highs. I'm going to take some risk off the table, or I'm not buying gold right here. You have to understand why you're owning something. And I think the reasons for owning gold and Bitcoin are going to be stable for the next few years. And it's for those reasons that I just mentioned. These are secular, long-term themes that I'm talking about. Now, I'd love to be proven wrong. I'd love for the U.S. government to get its act together and start paying down the debt and running a surplus. I just don't see it.
Yeah, and even within that secular tailwind, you're still going to have fluctuations up or down. Gold may pull back, Bitcoin may pull back, but I think what you're saying is, as long as the fiscal situation in the U.S. is what it is and the spending situation is what it is, that there's likely going to be a tailwind behind those asset classes over the next 2, 3, 5 years and longer. And from my standpoint, the U.S. and other developed nations are probably only going to address their current situation when there's a crisis. I don't think they're going to do it because, hey, we're going to wake up on a Thursday and decide to address it. It'll likely have to come as a result of crisis, and then they'll come up with a game plan on how to hopefully extricate themselves and get everything back on more sound footing. Who knows what that looks like? Who knows when that happens? But I think that's probably something out there in the next, 3 to 7 years.
And so the other thing I'll say in that vein, we do this podcast once per month, and a prospective client watched our last month's video and said something to the effect like, oh, gold and Bitcoin have really gone higher. You were talking about them. I was really alarmed by your comments. And look, nothing that we own, one, is for everybody. Two, it's not an accident. It's not like these assets, gold and Bitcoin, have done well over the past 6 months and we've piled in. I've been writing about gold for 10 plus years. You've been a gold investor for longer than that. I tried to introduce Bitcoin in client portfolios back in 2017. I couldn't do it because of the SEC. It was really the Wild West. So these are all intentional, calculated bets that we're making. And again, price is always right. You can not like gold, not like Bitcoin, but you can't argue with price. And at some point, I think investors would do well, even if you don't like those asset classes, to say, hey, the folks that were early on that, the folks that were invested in that have been right. I want to understand what I missed. So it's just a different mentality of a professional investor to try to understand what you could have missed and how the modern investment portfolio evolves or potentially changes over time.
Yeah, and I think Bitcoin, the last year and a half since we've owned it in client portfolios, has done really well. It's had some ups and downs, to be sure, but overall it's done well. Gold, there's been times where, we've been scratching our head about, hey, why is gold doing what it's doing? When is it going to start to help the portfolios? And so, we don't necessarily own gold because it's going to go up 30, 40, 50% in a year. We own it because it's a non-correlated asset in the portfolio, and it acts as a nice ballast against a stock portfolio. But there's certainly periods of time where it doesn't necessarily cooperate with what we'd like to see.
Well, and what we really focus on, like you talked about the performance side, and I feel like a lot of investors, a lot of do-it-yourself investors fall into this trap where they're very in tune with performance. I'm up 15% this year. I'm up 10% this year. Most investors, and I would include folks that work with other advisors, have no clue how much risk that they're taking until it's too late. So one thing that I've been writing about, and I wrote about in May, I believe, really difficult markets like the one we experienced in April are a great learning opportunity to see where the landmines, the breaking points are in your portfolio. So when the S&P is down by 25% in a month and a half, I want to understand how all of our investment models, our asset allocation reacts in that type of environment. And this is the rare year, and I'm going to toot our own horn a bit, where our portfolios are doing really well on the upside, but taking about 40% of the risk on the downside of the S&P 500, let's say. Now, I can't get into numbers because that's a compliance nightmare, but gold, Bitcoin, emerging markets, foreign stocks, a lot of these other out of favor asset classes or long-term themes that we've been talking about have really played out. And the magic, yeah, it's great to be up 15, 20% or whatever, but the magic really happens on the downside. Most of our clients are retired or about to retire. We are not a hedge fund. It's not take a boatload of risk with a blindfold on, try to make this thing grow as much as possible. And then, once the downside comes, we'll make a bunch of changes. That's how a lot of investors operate. And it's a recipe for disaster. So if your advisor is not showing you risk in drawdown, you're setting yourself up for a difficult time because risks are always lurking. You want to understand where those risks are. You need an umbrella before it rains.
Well said. I've got one more question for you, but do you have anything for me on your?
So this is not your company line, but what's your attitude towards gold right now? You must fist pump every day that you see gold up 1%, 2%, knowing that you've been a proponent of gold, both personally and at Pure.
Yeah, I kind of have a strange mindset in that when things are straight up from 3,000 to 4,000 in the past, 9 months, 6 months?
Mm-hmm.
So I guess, on the one hand, I'm pleased because it's helping client portfolios. I own gold myself, so it's helping my portfolio. But, I also get a little bit uncomfortable when things tend to go in your favor consistently. So I'm happy, but I'm also wanting to make sure that I'm not getting out over my skis from a gold standpoint. And so in some cases, I've trimmed back allocations to gold just to make sure that we're owning the right amount and not just riding the up and then taking it back down the other side.
Yeah, that makes sense. And one thing you said has stuck out to me. I've been doing this for 20 plus years. And when things seem too good, when things seem easy, when investing seems easy, that's when I get uncomfortable. The seeds to the next crisis are not sown during bad times. They're sown during good times. More poor investment decisions get made during prosperous times because we think those times are going to continue than get made during poor times. So I'm feeling a little uncomfortable with the complacency out there when your friends are talking about how much money they've made in XYZ cryptocurrency or this AI stock, and folks on Twitter are showing screenshots of their net worth and their portfolio gains. That's a sentiment top, in my opinion, and I've written a lot about sentiment. It's one of our rules. When people think that we're in a doom loop and times are bad and it's never going to get better, that's usually a pretty good time to invest. When folks are euphoric, they're complacent, they're flexing online, that's usually a time to exercise some caution. So that's what I'm feeling right now.
Yeah, if you look at it, stocks, all-time highs, gold, all-time high, crypto, all-time high,
Real estate,
all-time highs. So you pretty much have every single major asset class at an all-time high. Maybe bonds would be the exception. So yeah, I kind of feel the same way. Like if we do get some sort of a reversal or some sort of a correction, which in a lot of ways would be healthy, you could see several of those asset classes, reverse course, fairly significantly. And that's why, maybe you touch on, we have a framework if that were to occur. But I agree with you. I'm a little uncomfortable when things are going this well.
do the Blazers make the playoffs this year?
Yes.
Really?
Yes.
No
hesitation. No hesitation. I think they've got several players that are going to break through this year. And I think this is their year to make a significant step. I don't think they're going to be competitive for the title, but I think they're going to be competitive to get into the playoffs, which would be quite a step in the right direction. What do you think?
I think they might get into the play-in and then they will not advance. It's just, I think we lack some shooting. We still lack, we've got Kamara, who's a elite 3-and-D player, like the modern NBA player, but I still think we need one more wing, which is a coveted position, right? Like the 6'7", 6'8" guy that can shoot threes and lock down the opponent's best player. I'd like one more of those. I think they need to trade Jeremy Grant. Maybe get back a a young piece, but they're certainly trending. A lot of folks gave Billups the third degree and said that he couldn't coach, but they did make tangible steps last year, and their young players continue to get better, which is a sign of coaching. I mean, that's a sign of a good coach.
Yeah, and sometimes young teams take a bigger step when you don't expect it. So maybe it'll be this year, maybe it won't. But sometimes teams will improve by, 15 wins in a year over year, and you don't really see it coming because everything falls into place and people take a step in their development. So we'll see. Hopefully that'll be the case. It's more fun to root for the Blazers when they're more competitive and better, but we'll see. I've got one more question for you.
Okay.
We don't necessarily get into this on the podcast, but maybe talk a little bit about Pure's service offering and ways that we're looking to hopefully enhance that this year, next year, some things that we might be looking at or things we're hoping to be able to bring to clients and prospects moving forward.
So our services extend beyond the investment management realm. Over the past year, we've launched an AI tax tool. Of course, we're not tax accountants, we're not CPAs, but we can analyze a client's tax return and look for opportunities to save money on taxes. We've partnered with a digital estate planning company where we can actually have a client or prospect answer 30 or so questions based on where they live, how they want their assets to flow, and out comes a legal will or trust. So that's been pretty slick. One gap in our offering that we've long tried to fill with various partnerships that we haven't quite nailed it yet is a advanced tax planning, advanced trust and estate planning offering for these complex issues around real estate or selling a business or just more complex tax topics. We've tried to partner with a large CPA firm. We've tried to bring on a tax consultant. So that's an area that we've made some progress on. We can't really talk about it yet, but it's coming down the pipeline where we could add a very impressive offering for clients to provide CPA advice, not just doing tax returns, but proactive advice, putting together wills and trust in-house with a credentialed legal person. That's something that many of our clients are asking about, and we certainly hear you. It's an area that we've have recognized as a gap in our offering, and we're working to address it.
Yeah, I think we're always in the spirit of continuous improvement, always trying to improve the value we bring to clients, and we think that we provide a great service at a very fair price, but we'd like to find ways to improve that service moving forward in tax planning, maybe tax prep, estate planning, or some of the areas, trust planning, charitable planning, or some of the areas that we're hoping to crack the code on and get better at over the next, call it, 6 to 12 months. And so hopefully we'll have some announcements in that regard that we can bring to clients and improve the service and offering that we provide.
Yeah, and I think that's been a key part of our ethos. Each year we've added something. Each year we've added to the client experience, and we haven't raised our fee. And we're big on client feedback. So at the end of each year, we usually send out a client survey. And through the course of our regular client meetings, clients give us feedback, and we take that feedback, and we very much have an entrepreneurial culture here. And we use that feedback to improve our offering, to improve the client experience. It's a growth mindset. We're not content with what we've built. It's been a great run. We appreciate our client partnerships, but we're always looking to improve. And that goes from our personal development, our associate development, and then company offerings in the way of the client experience. So, we haven't nailed down anything yet, but we've made progress. A lot of these things are complex and they take a while to come together, but we hope within the next few months to have some tangible offerings that clients can tap into. Perfect. Okay. Well, thanks for tuning in to another Happy Half Hour. That's Toby Weber. I'm Nick Shermans. We'll see you next month.
Cheers.